Hey, 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 everybody. It's Friday, and you know what that means. That's right. It is another episode of The Real Deal Pod with Allister and Geoff. It is episode number 84. It is a rainy Friday, but it's still me, your trusted realtor, Allister Carrington, alongside our main man, our mortgage guru, our trusted mortgage broker, Geoff Lee. Geoff, buddy, how's it going? You staying dry?
I am staying dry. Yes, it's Friday. I just got off of a conference with Be the Better Brokers.
Nice.
Listened to many economists and any lots of insight as far as what our country is going to look moving forward. Yeah, it's pretty interesting, pretty exciting
Conferences are
news.
good. Conferences are good. I mean, we'll probably get into this a little bit in the a little bit later in the pod. I don't know what you have in. Oh no, I do know what you have in stored for us. It's part three of our. It's part three of what we've been talking about. So we had the rate announcement, and they came back as staying flat. Did you guys touch on that?
Yeah, there was an economist from Manulife, there was an economist from Scotiabank, another one from Toronto Dominion, there was another one from Ireland, and really the consensus, and I often joke the only thing economists agree on is nothing, but all these economists agreed on the same things, which was pleasantly surprising. And when it came to the conversation of rates, and the Bank of Canada moving rates either up or down, it was a consensus that, you know what, our rate probably is going to be the same. They feel that it would take something quite drastic for rates to kind of dip down. And if they do, maybe it's going to be a maximum of 50 basis points. But it's going to take a lot of bad news here within Canada for that to happen. But the overall consensus is we've kind of bottomed out on rates, and where rates are as of today probably is probably where we're going to be seeing them moving forward. And there's really no rate prediction as far as our prime rate to continue to go down. All of these economists believe that our prime rate is here to stay, and they feel in 2026 it's not going to move much.
No, that's good to know because that's right in line with a with an article that I read. I think it was beginning of January where that's one of the things that where they were predicting that we were just going to stay flat pretty
Yeah.
much the entire year, which is great because it's gonna it we're finally now getting into a sense of consistency, right? It now we can it allows us as Canadians to kind of really understand where our pocketbook is going to be, what it's going to look like. I mean, I know there's been a couple of crazy things levied uh, by that person down south. But I always say to people, take it with a grain of salt, right? So it's good to know that within our borders, we'll have some level of consistency, long as we get those Alberta people under control as well. So.
Yeah, it was interesting that these economists were definitely not big fans of Donald Trump. None of them. We actually had a couple of American speakers as well, which were also not big fans of Donald Trump. And kind of the messaging with that is that we've always kind of, as a country, we've always relied on the U.S. as a big brother.
Yep.
And I'm just kind of paraphrasing my own interpretation, but in our time, we've become very comfortable relying on Big Brother.
Let's be
And
honest, we become too relying
right.
on Big Brother.
And being very comfortable and just being okay with, what Big Brother says, Big Brother goes. And now that Big Brother is kind of being a little bit more difficult and not being as close as we thought, it's putting a lot of shockwaves through our country, which it has. And the overall again consensus is, you know what? Canada has been comfortable for far too long. This wave of change and discomfort is going to be a great thing for our country. We have the ability to do what needs to be done and take action steps to move forward and do that confidently, and reestablish connections with maybe distant cousins or things to move forward better and stronger. And surprisingly, there was a consensus that we have the right person with Carney moving forward and doing that. One of
That's
the
no
things.
surprise, Jeff. That's something that I was saying when the elections were going on. How a bunch of myself and other people within the party left the Conservatives become independents because we knew that that was the right man at the moment for to be in charge.
Yeah, and I'll be honest. I think Trudeau has put such a distaste in my mouth about the Liberal government, and I've just purely have not been a fan of the Liberal government, and really just I think when you get kicked in the nuts enough times by somebody, you just don't like anything about what that party represents. And again, being at this conference, one of the takeaways that I took away is that Mark Carney typically is one of the smartest people in the room, but also plays like the dumbest person in the room,
Yeah.
and really is a very strategic thinker, is a very hard-working individual, and is always like a good chess player, making moves before the moves kind of idea, and things that he is doing is very strategic, and sometimes what he's doing will make the other side feel like it was their choice and it was their way, that this is the reason why Canada is doing what it's doing, and in fact it's actually almost a counter manipulative tactic, whereas like we were going to do it anyways, right? But we're making you feel better because now you feel better that we're doing it, which gives them possibly a false sense of confidence. And yeah, so you know what? I felt really good about our country, and I felt better about our leader, and I felt good about how we're moving forward. And another takeaway that I got was, you know what? Mr. Trump makes a lot of noise, and that's what he does. But if you
Yeah.
take a look at a lot of the noise that he has done in regards to Canada, not very much of that has actually fallen through yet.
No.
So, mute the noise was a common kind of message. Mute the noise, because that's what it is. And if you take a look as far as what that noise has been for the last 12 months, there's very little that actually has come to fruition. So,
Yep. Another thing that I've been beating the drum about since his first presidency and since the second is that a lot of the things that he says is just to is just to distract from the problems that he's got going on. So that's
yeah.
why.
And even to add to that, another thing that came in the conversation was it could have been Camilla Harris that would have done the exact same thing that Trump is doing. Like what Trump is doing is exactly what the next president was going to do. It would have just came at a different voice through a different person. Maybe the messaging would have been a little bit cleaner and a little bit more respectful. But what Trump is doing in the US is no different than if it was Camilla Harris that took office, right? So it's just a matter, and that was actually a little bit interesting to me as well.
Yeah.
But this is just the direction that the U.S. has taken, regardless of as far as who is leading it. It was going to happen in a very similar way. Um, and in this case, it's just happening through Trump. But again, that could have just been through a Camilla Harris or whomever it would have been at the time, right? So that actually surprised me a little bit as well when I heard that.
Yeah, it's really interesting. Just going back to touch on Carney quickly, because of course I follow all this stuff, and one of the things that people are saying, and you can see it happening, and I'm very interested and excited, and I love his ambition for it, because of the he sort of tipped his hand in the Davos speech. I don't know if you've probably heard the speech that went on in Davos.
Mhm.
I was super proud of him, but one of the things that people that one of the things, sorry, that I'd been reading was he's had a plan for a long time because he saw the breakup of the global world, right? The change of the norms, right? He saw it years back. And so now what he's positioning Canada to be is a superpower of the middle powers. And I love that. Is that it will be we will become now um, the almost the United States of the world, where people look to us for trust. And really it's a lot of it is because of how we've traditionally carried our country, just in
Yeah.
terms of our politics, right, on the global stage, and our banking system, and just the stability that Canada always has been, right? So when the world is now looking for something, is finally looking to be some, or looking for something stable, he's positioning Canada to be that thing that they look at. So
Yeah.
I'm actually very excited to see how it goes.
Yeah. And it takes time. So that was
Oh,
the
of
other
course it
thing
does.
that came to light, is that this
It's
is not
not.
happening tomorrow. Like
It
this
is
is
hilarious.
yeah.
That's always been one of the funniest things I've ever heard, Geoff, is when people are like, "Oh, well." I remember hearing. I was having a talk with my father-in-law, because he's a ex-conservative as well now. He's moved over to independent as well, and he was asking me about, what was it, about 6 months ago, how I felt Carney was doing, and I said, "Oh, he's doing fine." And he was telling me about how he was getting into an argument with a friend of his who still is a conservative, and the guy was complaining, "Oh, well, Carney hasn't done anything. Nothing's changed." And I'm like, he's only had his job for 6 months. What is he supposed to do? Be a genie, blink his eyes, and everything's changed? And that is just where I always caution everybody. Like, you just caution everybody, understanding, yes, we live in this ridiculous era of instant gratification, where we believe everything should be changed at a moment's notice. But the fact of the matter is, the reality is, nothing is done at the blink of an eye,
Yeah.
right? It's just nothing's done that way. So it's just funny to hear people still believe that things should be changed around at the blink of an eye.
Yeah. Takes
Yeah,
time.
yeah, man. Awesome. Well, let's get into it, buddy. Let's get into it and start off with the hottest segment in podcast right now, and it is still, what
Did
Did you
you
know?
know?
That's right, baby. Did you know? So, Geoff, I know we've been talking a lot about what developers have been going through over the last little bit. But did you know, Geoff, that Canadian developers are sitting on the largest number of completed, unsold new homes in modern history?
I didn't know that, but I'm not surprised.
Yeah. So according to CMHC data, there were just under 19,000 brand new homes sitting vacant and unsold in December. That's up more than 35% from last year, and it officially surpasses, I beg your pardon, the previous record set back in 1991.
Wow.
Now, this is where it gets really interesting. Nearly half of those unsold homes are in Toronto and Vancouver.
Yeah.
Yeah. So, and the thing that makes that remarkable is because that's not normally the way Canada works. Most new homes are sold, of course, before they're even built. And I'm not sure if we've really explained this to our listeners, but developers typically need about 70% of pre-sold units just to break ground. Seeing completed inventory sitting empty is like this is highly unusual. In Toronto alone, inventory of completed and unsold new homes is up almost 57% year over year. And these are levels that they've only seen during the early 90s crash and the 2014 oil slump.
Wow.
And
Wow.
remember, investors bought roughly 3 out of every 4 pre-construction units there. And that tells us that end user demand is struggling to absorb what's been built. Vancouver is a similar story, and maybe even more striking. Completed and unsold inventory here is just 4 units shy of an all-time record, and more than double the long-term average, despite having less than half of Toronto's population. So we officially hold over a quarter of all vacant new homes in Canada.
Yeah.
So the question becomes, why hasn't prices dropped more? Vacancy taxes should apply pressure, but many of these units are exempt just as long as they're listed for sale. In Vancouver and federally, those exemptions can last indefinitely, and Toronto's exemption is just 2 years. So that's one of the major factors or one of the major differences between ourselves and Vancouver is our vacancy tax can be almost indefinite, indefinite as long as sale. In Toronto, they've only got 2 years on that timeline. And the bigger issue is this: sales, of course, are at a record low, and inventory is continuing to rise. And there's still a large pipeline of new construction coming. At the same time, there's very little on the horizon creating upward pressure or upward pricing pressure, I beg your pardon. So this doesn't mean, of course, that prices are going to collapse tomorrow, but what it does mean is the balance of power, of course, is shifting. And that's where, again, I just wanted to take time for our listeners to understand that as buyers, this environment creates so much opportunity, not just in the resale end of things, properties that have already been bought and sold, but also on the new build side of things. Because just because a property might be listed, let's say at $675,000, it doesn't mean that that price can't be negotiated. Mm-hmm. And these developers need to sell things. So again, I just wanted to take the time. When I read that, I actually didn't know that we held so much of Canada's unsold inventory. Right? We talk about it all the time about how developers are in so much trouble. I just didn't realize how much ourselves in Vancouver we own. Right? And so with all of that, we have so much opportunity to, again, put our net worth in a better place.
Yeah.
What are your thoughts, Geoff?
Well, again, I'm just kind of paraphrasing things that I've heard in the conference that I was just at, is that if you take a look at the overall real estate market, there's a lot of cities that are actually performing very, very well. But when you take a look at it on a country scale of things, it really is Vancouver and Toronto that are really dragging the markets down, like as a nation average, right?
Yeah.
So, I didn't know how much inventory we had. I'm not surprised that we have that much, and I'm not really surprised on how much we hold, considering that it's Toronto and Vancouver that's kind of bringing down that national average, right?
I thought Toronto would hold the most, and to be honest with you, I thought Toronto would be outholding us.
Well, if we hold half, they probably hold close to the other half. So
Yeah.
I don't think we're too far away from one another. But again, I forgot about the vacancy tax,
Yeah.
right? So that being indefinite here in BC, I think is a good thing. That having a time clause in Toronto could be another bad thing for these developers. But
Huge.
I also know that, as from what I understand, a lot of development has stopped or is coming to a slow. I also will understand that people are still going to continue to buy. And they say within the next 2 years, you're going to see a rebound in that condo market because now the demand is going to be greater than the supply. So right now the supply is much greater than the demand. And actually, I'm looking at my notes over the last 3 days, and I put a big star on it. Is it a good time to buy a property? Right?
Yeah.
And again, yes, condo prices may drop another 10% in the next 12 months. They don't really expect it to drop much more.
They
Um,
sorry, they predicted 10?
yeah, in the condo
Wow.
side.
Wow. I know, and the only reason I say that is everything that I've read, they're predicting 3 to 5. So that's a That's a
Yeah.
drastic change into
So again,
10.
I'm paraphrasing, and this is Jeff's interpretation of a lot of information.
Yeah. No, no.
But they are expecting the condo market to drop, say, up to 10%
Sure. Yeah.
here in the next year.
Yeah.
But they also said it's not very wise to try to time it either,
Nope.
right? And as you start to time it, that's when things can fall apart on you, and nobody will ever, well, I shouldn't say nobody. There are people that can time it well, but most people don't,
Yeah.
right? And a lot of times, and we've seen this in the past, Allister, when people try to time the rates or time the market, and I've said this in the past, they usually time themselves out.
Yeah.
And when they're all of a sudden ready to move and ready to move forward, now all of a sudden that market has rebounded and you're a little bit slow to take. So again, like, yes, is the market, condo market more so than the townhouse or the detached, is that going to continue to decline in the next 12 months? The consensus is yes. The conversation is how much, and everybody will have an opinion on that. But I think if you were to talk to most people, now is if you are in that condo market, now is as good as ever of a time to buy. You have a lot of supply. Right now, you have very little demand. Our rates are probably flattened out to where they need to be. People have been on the fence for probably 12 plus months because of the uncertainty,
Yeah.
right? And again, we got to remind ourselves this discussion we were having last year at the same time. Last year was supposed to be the rebound market of real estate,
Yeah.
until the tariff conversation came into the mix,
Yeah.
right? Now we're seeing that this tariff conversation is getting a little bit old, right? We're seeing that a lot of that conversation hasn't really taken in effect. And again, one of the economists says you'll probably will see a tariff of about 10% on most goods. That's kind of so they are coming, but keep in mind we've always had tariffs, but just not on everything.
Yeah.
And I think it's just becomes a normal conversation after a while, and people feel comfortable. And as they start to feel normal in that conversation, then you're going to start to see um, that supply diminish because, again, people are going to start to move forward. The real estate cycle always will do the same thing and never stays flat and
Nope.
never stays on the low end. It will always come back, and there's no reason why this one isn't going to come back because it never has basically bottomed out.
Yeah. No, it's true. And just to quickly touch on that, not so much the new build end of things, but also you see this in the resale condos is that the value that you're getting for with these condos is greater than what you'll get in almost any, well, in any other market, not almost in any other market that you'll be in, because you have people now that are renovating their properties and not even charging so much for those renovations to be done. They're doing it so that their property can be sold. Of course, that what we've always sat in is lack of inventory. So normally those condos that you were getting in, if you could find something that was renovated, you knew you were paying a premium price, but you were happy to be able to find that because most people weren't doing that. Now people are doing that in order to sell,
Yeah.
right? And so you don't get this type of value, whether it be the new build sector of things or the resale side of things. You don't get this value. So again, to what we've been saying, for many, many a months now, right? There is really no better time to buy, especially if you can afford it as a first time buyer. I mean, we're going to have different, people can argue about the townhomes and the single families because those are moving, right? That category is selling right now, right? But if you're a first time buyer, right, you don't really have these types of opportunities, and these are the times that you really should look at getting into your market again, for you, not just for anything but your net worth, as we consistently say.
Yeah. The other thing that, I'm full of stats after this conference. You, it was mentioned that you are 6 to 7 times wealthier if you own a home versus renting.
Yeah, goes right in line with the numbers that we've been giving.
Yeah.
Yeah.
So again, like I think we're gonna do a pod just on all my little Coles notes that I wrote over the last 3 days. But
That'd be
yeah,
awesome.
statistically speaking, if you own a home, you are going to be 6 to 7 times wealthier than a person who rents,
Yeah.
right? And just again shows the value of home ownership. Another economist actually said, you know what? Owning a home is worth than owning a bar of gold,
Yeah.
right? If you take a look at the return on investment over a
Sure.
period of time.
Yeah.
So again, yeah, a lot of positive things that came out of it that I think it's important for the general public to understand and know because all these came from some very high profile minds,
Yeah.
highly regarded in their industries. And again, all saying the same thing. So when everybody is saying the same thing, I think there's going to be some truth to it, right?
Uh,
So
100%. 100%.
yeah.
Awesome, man. Well, that's my did you know and insights for today, all wrapped into one.
I like it. I like it. I was looking at the clock here and I'm like, oh, geez, I don't know if we're going to be able to get through all this
No,
because
man, we got to get part three done.
we are already 30 minutes in. So yeah, let's jump into our third week of three mortgage mistakes that Canadians are making in 2026. And let's be honest, have always been making
Right?
prior to 2026. But as I've been kind of presenting and talking about these three mortgage mistakes, it's just again having the knowledge of what they are, right? And once you have the knowledge of what they are, or even just a scratch of what they are, when it comes to a conversation that you're having with your sphere of influence or you're having with yourself, you're going to be like, yeah, I kind of remember this. So if we can take just little parts of this away and be stuck with it, again, I'll use this conference that I've been in. It was probably 20 plus hours of just, of information. I may have only remembered 30 minutes of what I remember was important to me, right? So, same thing with these three mortgage mistakes. You're not going to digest everything, but hopefully you're going to take away something that's going to be important to you. And if you're able to do that, again, by avoiding these three mistakes, and we're going to talk about the third one this week, could possibly save you thousands and thousands of dollars, right? So again, I always like to come back when we do these little mini series is come back to what we originally talked about. And what we need to understand is that there's going to be well over 1 million mortgages that are going to be renewing here in 2026. What we know is going to be, these people that are renewing their mortgages, their rates are going to be 2 to 3% higher than what they were paying. And what we do know based on a 2024 study, Canadians are in their highest debt load that our country has ever seen of around $2.5 trillion. So again, just to kind of come back to week number one, mistake number one was the loyalty tax. And again, remember the loyalty tax is your mortgage is coming up for renewal. You're getting the renewal letter from your bank. You're taking that first offer as their last offer. You're accepting it. And again, you're moving forward, not understanding that that first offer is not their last offer. You're not understanding that you can shop that offer around and understanding that if you take that offer, like 72% of us will, 7 out of 10 people will take that first offer. You can be paying as much as 1% higher than if you were to shop that mortgage around. And when we did the math on that, that was roughly around $15,000, right?
Yeah.
As far as mistake number one called the loyalty tax. Mistake number two was called that cash flow leak, and it goes back to that $2.5 trillion of debt. Debt that you have, Alistair, debt that I have, debt that every listener on here has. We accumulated that debt, and when we add it all together up as a country, $2.5 trillion. And also understanding where that debt is. If that debt is in credit cards at paying at 19%, if that's in auto loans paying, up to 7%, if that's in personal loans paying up to 10%, wherever that debt is, understanding that that $1 of debt, depending on where it is, could cost you 4 times of what that dollar is worth. And then that cash flow leak was all about where is your debt? What interest are you paying on that debt? Your mortgage is coming up for renewal, or even possibly you're doing a refinance, restructuring that high interest debt, sticking it back into your mortgage, and basically paying a much lower payment on that at a much lower rate, and as a result injecting cash flow back into your pockets, right? And when we did that scenario, I think it was anywhere from $300 to $500 a month, which equated to 15 plus thousand or 15 to $30,000 a year, just by restructuring your debt load. And again, we talked that your debt's not going away. It's not a magic eraser where it disappears. It's just a matter of where you're putting it, and then basically restructuring it. And then doing that, again, getting rid of that high interest debt, put it into low interest mortgage debt. And then as a result, same debt, just depending on where it's sitting and the rate that you're paying, injecting a large amount of cash flow into families' pockets each and every month. That was mistake number 2. The third mistake that we're going to talk about today is called that options myth. And the options myth is really understanding that people have over 100 different mortgage options available to them. In fact, I actually had to fact check that. It was like, 100, that's a lot. And I was talking to a colleague of mine, and he's like, yeah, it's actually thousands if you really want to come down to it, as far as the mortgage options that people have. And I'm not saying that, Allister, you have 100 different mortgage options when your renewal comes, because again, you're self-employed, you have a great business as a tax strategy, you're not reporting a large amount of income. That doesn't mean you're going to have 100 plus options. You might only have 6.
Yeah.
But again, the idea of this and the understanding of this is that people, depending on your situation, you have options. It's not just going to be the only option that your bank is going to, to give you.
Yeah.
And again, a lot of people believe this is because they automatically think the bank is their best option, right? They believe that if they haven't heard of a lender, that they must be risky. It must be like Tony and Luigi on the docks lending them money, and like what's going on here? Like, I haven't heard of them, right?
Yeah. Yeah.
People old school, like, your parents, my parents, their grandparents said, well, I need a physical branch to trust them. I need to be able to see them. I need to be able to feel them.
Yeah.
I need to be able to, like, walk into a branch in order to trust them.
Yeah.
And let's be honest, you walk into a branch, you got a lineup of 25 people in there with two tellers, and the first thing they ask you is, well, you can do this at the
Online.
automated
Yeah.
station over here, right?
Yeah. Yeah.
So again, understand, even with these physical branches, those are going to be a thing of the past at some, I'm not going to say in the near future, but at some point.
Yep.
And then just the belief that your banks have the best rate, and we're familiar with them. But again, when you believe that, you're really limiting yourself as far as understanding the options that you have, and understand that there are more than 6 lenders here in Canada, right? There's more than your big 6 banks, and there's more lenders than your Bank of Montreal's, your RBC's, your TD's, your Scotia's, your National Bank. Like there's hundreds actually of lenders here in Canada. And a lot of times you haven't heard of them because they don't market to you as the general public, right? You're not, and that's one of the reasons why, again, that they're quite often able to offer people lower rates and a better product, because again, their primary business is mortgages. Their primary business isn't credit cards, isn't tax-free savings account, isn't investments like your big 6 banks, right? Your big 6 banks are known, they're trusted because they've had so much marketing dollars injected into our social system. So they've done a great job of knowing them, liking them, and trusting them. And again, you do enough advertising, you see them on enough street corners, and you know enough people to do them, it's just an automatic trust thing, right?
Yep.
Understand that there's credit unions. Okay, outside of the major banks, there's credit unions, and we've heard of them: Envision, Prospera, Coast Capital, So again, these are member focused community-based lenders, right? Understand that they're provincially regulated lenders, so they're only happening in the province where you live in. And then there's the third type of lender on the conventional side called monoline lenders, right? And monoline lenders are only available to mortgage brokers, and they only sell mortgage products, right? Uh, there's no branches. Because there's no branches, they have much lower overhead, and as a result, they have better rates.
Yeah.
And quite often, and we've talked about this in past posts, is they have better personalities within their mortgage. They have often better prepayment privileges. How they calculate the penalties are always better than a big six bank. And they have better like porting options and blending and extending and all that other fun things that people should be asking outside of the rate. Then there's B lenders. That's when we can't get it done through a conventional lender, and that could be a lot of times, Allister, and we've talked about this, self-employed people, people that don't debt service, and we've all, I'm air quoting it, but you don't debt service based on your income. So we use these types of lenders for a lot of business for self people. And then we use private lenders, and these are equity-based lenders. And here's really where I want to go with this. All of these lenders are regulated by the same governing bodies, right? All of these lenders are fully legitimate, but they are just built differently because everybody doesn't have the same ability to get the same mortgage, right? Everybody's needs and wants are different. Often they're not two of the same. But this is good news because there are people out there, Alistair, they just want the best rate, right?
Yeah.
There are people that are out there that want to have the ability to make extra payments. There's people out there that need to understand that, hey, 7 out of 10 mortgages, or 6 out of 10, 6 or 7 out of 10 mortgages are going to be broken within the first 3 years of the term. And how you calculate that penalty can be a huge game changer for you, the borrower, as far as what's coming out of the pocket. I'm going to run some numbers for you on that. Some people just want to set it and forget it. They just want something simple. They want something stable, and away they go. And then there's that whole pie of business for self people that want to have a great business or have a great business, don't want to report a lot of income because they don't want to have a big, huge personal tax bill. And then again, now all of a sudden you're reporting, 40, $80,000 and wanting to buy a $1.8 million home. So how are you going to do that, right? So there is no everybody has a different need for the mortgages that are out there. And like I said, very, very important to understand that there are more lenders than just the six that you're very, very familiar with, right? So yeah, here we go. I thought it was seven, or I knew it was 6 or 7 out of 10, but again, 60% of Canadians, Alistair, gonna break their mortgage within how many years?
3 to 5.
Well, within
Three.
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 Yeah.
Yeah.
They're going to break it within 3 years.
Yeah.
6 out of 10 of people who have a mortgage will be breaking that mortgage within 3 years, right? And again, why? Why are they going to do that?
A lot of times they're moving because they're maybe having a baby, or I have a client that's just breaking their mortgage now and we're looking at buying a new home because in a matter of 3 years they're on their third baby.
Yeah. So, they were in a townhouse. Now they got to move to a detached home,
Yeah.
right? Or
Yeah.
they were in a condo and now they've outgrown that condo and they're going to a townhouse.
Yeah.
It could be
You might
job
have a
opportunity.
death. Yeah, job opportunity, death,
We came into an environment of rates just 2 years ago where a lot of people were paying 5+%, right? The rates now have corrected, and again, if people are paying over 4.3% in their mortgage, now is a really good time to break that mortgage and restructure, right? So again, that's a reason. Again, we've talked about this before: divorce and separation,
Yeah.
right? Medical events. 1 out of 3 of us will get cancer. 33% of us will get cancer, right?
Yeah.
So how are again, there's just so many different reasons why people break their mortgage. But what we do know regardless of what that reason is that 6 out of 10 of us who have a mortgage will break that mortgage within 3 years. So even if you have the best rate in the world, if you're with the wrong lender and you need to break that mortgage, you could be up the creek without a paddle,
Yep.
right? So again, I want to paint the picture because everybody always likes to hear the dollars. A $500,000 mortgage, Alistair,
Yes,
with
sir.
2 years remaining. If that mortgage is with, say, a big six bank in a fixed rate, tell me how much do you think that mortgage is going to cost you to break?
You've got how long are you breaking it after? You got how many years do you have left?
You got 2 years left. You're in a $500,000 mortgage. You're with one of the big six banks. The penalty to break that is ish
From percentage or dollars?
dollars.
Oh man.
It's
I'm gonna that's what
$23,000.
I was gonna say 60, so I'm a little bit on the high end, but that's
Yeah,
crazy. That's crazy though.
that is crazy. So again, well, let's just kind of reframe it. A $500,000 mortgage in a fixed rate with, say, 2 years remaining. If you're with a big six bank, it's going to cost you around 23 grand. If you are with one of those monoline lenders, the lender that you never heard of but you feel is risky, that penalty is $4,000. That's a difference of $19,000 depending on the lender that you're with. And
I was
remember
gonna
that
go with 7. So even there I was high on that end.
yeah, so remember that monoline lender, people are like, oh, I don't want to go with an RFA. I don't want to go with an AMCAP. I don't want to go with a First National. I don't want to go with this lender that I'm not familiar with. Well, again, keeping in mind, these are regulated by the same governing bodies. They're pretty much the same. It's the same. The only difference is how they calculate the penalty, right? That's a $19,000 difference in the same mortgage, the same the same homeowner, the same life change. Again, the only difference is who's holding that mortgage. Is it a big six bank or is it a monoline lender? So is $19,000 going to make a difference in your life?
A
I
little
would
bit.
say so,
Yeah.
right?
You know what, Jeff? You're making me feel like those big six banks are Jim and Tony on the docks.
Don't get me wrong, like
I'm
there's always
joking.
a need for every type of lender.
I know.
Really, what I want to do is educate people to say, hey, you know what? There are more options for you than the big six lender, right? And the big six, when it comes to penalty breaks, and again, 6 out of 10 of us are going to break the penalty, break your mortgage. Again, understand that there is a difference on how the big six will calculate that penalty to how other lenders will calculate that penalty. And based on a $500,000 mortgage with 2 years remaining, with the big six bank, that's around 23 grand. With the monoline lender, that's 4 grand. Same mortgage, same situation. Only difference is who's holding that mortgage. That's $19,000 that you're not putting in your pocket, right?
Crazy.
So the whole idea with our pods is just to give ourselves some knowledge. Do I expect everyone to remember what we just said? No. What I do want people to remember is hopefully they're going to take something out of here. And when that time comes, when it applies to you or your family or your network, you can be that source of resource to say, well, hey, I heard this. And you giving them that bit of information could be saving them thousands of dollars. And I always say that's the greatest gift, right? Knowledge is the greatest gift. And if you can pass that knowledge to somebody that actually does something significant with it, you're the biggest hero kind of idea. So again, that's really it. And again, just to kind of sum it up, just to kind of wrap this up all together, there are 3 mistakes Canadians have always made, right? Doesn't matter if we're in 2026 or 1989. There are 3 mistakes that Canadians have always made, but moving forward, we want to make sure that you're not one of those Canadians or you're passing this knowledge on to people so they're not one of those Canadians. And remember, the first mistake is called that loyalty tax. And that is for anyone that is having a mortgage coming up for renewal. And there's a lot of us in 2026, there's well over 1 million. You're taking that first offer from the bank, considering it to be the last offer, not shopping it around, and statistically speaking, you are going to be having roughly around a $15,000 mistake by taking that first offer, not shopping around, because you're loyal. I'm
Yep.
loyal to that bank. So that's called the loyalty tax. The second mistake is people having high interest debt that's higher than their mortgage and not restructuring that debt within their mortgage at time of renewal or even at a refinance time and restructuring that 19% debt or that 10% debt or that 12% debt, any debt that's higher than your mortgage, not restructuring it, putting it into your mortgage, and basically as a result, freeing up massive amounts of cash flow, right?
Yeah.
The third mistake is, remember, that's called the cash flow leak,
Right.
right? And then that third mistake is the options myth, and just believing that, hey, the only option I have is the six big banks and what they have to offer, and not realizing that there's over 40 different lenders with over 100 different mortgage products that basically may suit you better than what's being offered. And again, if you are with the wrong lender, understanding that you're going to break your mortgage very likely within the first 3 years, how they calculate that penalty could be, again, in the example we set out, a $19,000 mistake, right? And that's it. Like again, knowledge is power. So surround yourself with knowledge and you're going to avoid a lot of mistakes. And that's not just in the mortgage world, that's pretty much in every we can apply that to everything.
That's life. That's in life. But that's exactly it. And you know, it's funny, like as we've gone through this series, I always try, I've been trying to think to myself, what is the most important out of those three? What is the most important mistake of those three to avoid? Right? And I got to be honest with you, I can't pick one. I think they're all hand in hand. They all go hand in hand together. So my plea to everybody listening is do everything you can to not make any of them, right? Don't just choose one and say, I'll make mistakes with the other ones, right?
Yeah.
Do everything you can do to not make any of these mistakes.
Well, the reality of all three of these mistakes, they happen at all different times,
Sure.
right?
Yeah.
Like the loyalty tax, like renewing with your existing lender, 7 out of 10 Canadians will happen on the renewal, right?
Right. Yeah.
The cash flow leak, as far as having high interest debt, like everybody that's listening to this pod has debt,
Exactly.
right? Anybody that has debt higher than your current mortgage rate, your mortgage interest rate, probably is making the mistake of the cash flow leak as we speak,
Yeah.
right?
Yeah.
And then again, like the options myth is just understanding that there's more options than what your big six banks offer, right?
Yeah.
There's many lenders out there with hundreds of different types of mortgages that may be best suited for you.
Yeah. Yeah.
So again, I think all three of these mistakes happen at all three different times. But again, like the conference I just came in, what I'm going to pull out of that conference to what somebody else is going to pull out of that conference is going to be different. But if you can just kind of, have that one or two pieces that you can remember, again, you could be saving yourself or your network around you by sharing that, thousands of dollars. And I think that's really important for people to know.
I think so too. And imagine the Christmas gift you're going to get from somebody if you save them $30,000. So imagine the Christmas gift, the thank you you're going to get from those people.
Yeah, you might have to remind them as Christmas comes along.
Exactly.
But
But yeah, just think, keep it on top of your head. You could get gifts like crazy. That's awesome. That's awesome, man. Well, that is, I think, one of the best pods we've done. We're walking away. People are walking away with the understanding that there's so much opportunity out there right now. If you're a first time home buyer or just looking to buy a condo or whatever you're looking to do, right there, that we've got the end of our 3-part series and how to save yourself from losing money so that you can actually use that to put down a down payment on a condo. So, I mean, I think we've done good. Just so people know the market out there, we're now hitting the end of January. So January 31st is tomorrow. We'll have the new stats come out on Monday. And actually, what I'm predicting is it to be a very, very interesting because I know I've been busy this month. I know a lot of my colleagues that I speak with have been busy this month, and we've all had the same consensus that this is one of the strangest Januaries that a lot of us have had in our career that have been doing it for a few years. And one of the things that we've noticed that outside of course, condos, we've noticed that in townhomes and single family homes, we've gotten into some offer situations where it's gone into multiple offers. And so that's telling you, again, that's telling everybody a lot of things that, one, sales are happening in January, which don't traditionally happen. But the other thing we're noticing is from a price point perspective, it's something that I alluded to earlier. People are willing to negotiate on value. So you may have one home that's priced at one thing. You might have another home that's across the street. And the reason why I'm using this is that this actually happened with one of our.
I thought we were wrapping this up, Allister.
We are wrapping it up quickly, but $100,000 less, and the one that was $100,000 more is the one that sold, and that's because of the value that's because of what those sellers put into their home in order to sell that home. So it goes right back to, again, the value that people are placing and they're willing to purchase on that value. So everybody, we're in this new world, right? The tariff speak's gone. What Geoff and I spoke on at the beginning, people are getting comfortable with the way that our world is going to be going. So please don't make these mistakes. Please take advantage of the opportunity that we're in, because in a year or so, I can tell you we're going to be out of that. So with that being said, thank you all for taking the time to listen to us today. We hope that this has been valuable to you. We hope that you walk away with at least one thing that's going to help you throughout this coming months and the rest of this year. And we hope that you walk away with something that you can tell your friends about. And when you do tell your friends about them, please encourage them to listen, love, like us, and share us. Have an amazing weekend. Stay dry. I'm not sure if it's supposed to get sunny, but if it doesn't, make sure that you got your puddle boots and your rain jackets on. We still call them puddle boots. We called them rain boots back in Winnipeg. I don't know where I got puddle boots from, but we'll go with puddle boots. But most importantly, Geoff, stay empowered, stay informed, and do what?
Stay tuned.
That's right, baby. Stay tuned. Peace out.